The important thing is, then what? We all know what's going to happen over the next year. Information that everybody has is not helpful because we all have it. Investing is a matter of knowing something other people don't know.
Today is a really special day for me. I've been invited by Chairman Howard Marks of Oaktree Capital to his New York office, and I'm pleased to share this interview today. For today's interview with Chairman Howard Marks, I've invited Mr. Jae Young Yang as a co-interviewer, who has long worked in the New York bond market and with whom I have a long-standing relationship. I believe about the bond market, capital markets, and investment markets. We'll have a much more in-depth discussion. First, let me introduce Mr. Jae Young Yang, who will be interviewing with me.
Hello everyone at Sampro TV. My name is Jae Young Yang. As Mr. Kim mentioned, I worked in US Treasury trading at HSBC for 6 to 7 years. Before that, I worked with subprime mortgages at Shear-Aegis. I've worked on Wall Street for nearly 20 years, and now I'm managing a bond fund in the Middle East. It's great to meet you all.
Thank you. Shall we introduce today's main guest? I'd like to introduce Chairman Howard Marks of Oaktree Capital. Thank you so much for your time today, Chairman.
It's a pleasure to be with my Korean friends again. My trip to Seoul in November was very positive, and I'm glad to have a second opportunity to speak with you.
Since our valuable interview at our office last November, I want to convey that Korean people have been deeply impressed by your insights and perspective and are very grateful. Now, with Chairman Howard Marks, we'll ask several questions about recent major changes and hear his insights. A few months ago, Chairman, you mentioned sea change, which could be translated in Korean as a complete transformation. Describing such a big change, you said this was the first major change you've witnessed since entering the industry in 1959, after 2 previous changes. Since then, there have been substantial changes. Inflation has come down considerably, and there's talk about the Fed pivoting on rate hikes. Do you still maintain your view about the fundamental sea change that you wrote about in your memo?
Over the last 40 years, we've had virtually all the time until last year either declining interest rates or super low interest rates. 40 years. That means that you and I and Jacob and almost everybody who's watching have rarely seen anything else. And this has shaped people's expectations. They think that's normal. But interest rates went from, I had a loan outstanding from a bank in 1980 at 22%. And then in 2020, I was able to borrow at 2%. Interest rates came down by what we say 2,000 basis points.
Yeah.
The one thing I'm sure of is that's not going to happen again. Because when interest rates are 2, they can't come down much. In this period, the second sea change was the opening of investors' minds to things that, to the taking of risk, as long as the risk appeared to be justified and rewarded.
Yeah.
So a high degree of prudence, a high degree of safety, an insistence on risk avoidance, all of these things disappeared. And now we have a weighing of risk and return. This is the second sea change. The third sea change occurred, it began at the beginning of 2009, when the Fed took the Fed funds rate to 0 in order to stimulate the economy and fight the global financial crisis, and began quantitative easing, buying bonds, which puts liquidity into the economy. This worked very well, and the economy made a recovery. Over the 13 years, from the beginning of 2009 until the end of 21, we had, again, declining or low interest rates, strong economy, no inflation, or insignificant inflation. This encouraged the Fed to continue lower The slogan was lower for longer. And with the Fed able to keep interest rates low and yet not have inflation, we had a strong economy, easy for companies to make money,
Yeah.
easy for companies to avoid default or bankruptcy, easy for companies to raise financing, even if they lost money, happy investors, eager buyers. Nobody was afraid. And it was just an easy environment to get everything done. And I would just say easier than normal. And so this can't go on forever. This is, what I'm talking about now is the groundwork for the third sea change.
Yeah.
So much money was pumped in to fight the pandemic effect on the economy. We started to see inflation. That means that the Fed can no longer remain lower for longer. They had to raise interest rates in order to fight inflation, cool off the economy. And, you know, inflation is primarily too much money chasing too few goods. So they had to cool the economy so that the demand for goods would cool off. I believe that there is a realization that keeping interest rates super low forever is not healthy. You can't stimulate constantly stimulate. The economy has to operate naturally, organically. And, you know, at the end of 2020 or the beginning of 2021, there was a belief that the Fed would, by constantly stimulating, could engineer perpetual prosperity. But it always sounded too good to be true to me. And now I think it's turning out that it is too good to be true, because now we have inflation. And the inflation, which is very bad for many aspects of the economy, prevents the Fed from continuing to stimulate. Now, in the current years, I think we'll probably have a recession because of the big increase in interest rates. The Fed raised rates last year the fastest in history, from 0 to 4.5% in 9 months. So we'll have a recession. It'll be harder to make money. It'll be harder to avoid bankruptcy and default. Bankruptcy and default rates will return in the direction of normal. It'll be harder to raise money for your company. And now, investors or lenders or providers of capital, on the one hand, they want to put their money to work, but on the other hand, they're a little worried about the future. So it's more balanced now.
Yeah.
So in many ways, I believe that the 13 years I'm talking about were unnatural and too easy. And in the coming years, it's going to be normal, which is a change. And, you know, if people came into our business 15 years ago, it's all they've ever seen. They think that's normal. It's not normal. That was the best of times. Now, I believe we're in more normal times. But we're not going to have 0 interest rates. We're going to have 2-3% interest rates, maybe 4.
Even 4.
And that will change everything.
While reading your sea change memo, I found something interesting you mentioned. In 1980, Howard had a loan with 22.25% interest, but in 2020, it was 2.25%. That's a 2,000 basis points or 20% decrease. You mentioned framing that 22.25% bill. So I wanted to ask, did you also frame the 2.25% bill from 2020?
It's not, but it should be.
Should be, right?
And I'll have to get a copy and print it.
Talking about that 2.25% bill refers to when the base rate was nearly 0%, which might be a future we'll never see again. Since there were only 2 sea changes in 50 years, would it be correct to interpret that such changes won't occur for at least the next 20 to 25 years?
We may or may not see it at that low. But I think the important thing is that rates have come down. I don't think they're going back up, but they come down. They're going to be more steady, but not so low. You know that when the Fed took the Fed funds rate to zero in '09, it kept it there for 7 years, and that's too long. It's unhealthy. Zero rates is an emergency measure. We didn't have an emergency for 7 years. The economy was, let's say, doing fine by 2012, 2013, 2014. So 3, 4, 5 years. Why keep it at zero for 7 years? And the market got used to zero rates, which was unhealthy. It's like a child with candy. And sometimes you have to take the candy away. But they didn't do it. And so this period was distorted by rates that were too low. The coming years, which will not see the same level of stimulus, will not be as much fun. But the economy and investing is not about fun. It's about doing what's prudent in uncertain circumstances.
Let me explain the frame I have here now. When Howard received his loan interest bill in 1980, the interest rate was, as mentioned, 22.25%. Howard thought this will never happen again, and framed that bill, as you can see here. As someone who once worked in bonds, when I think about that time, it gives me chills. So I requested Howard to frame his 2.25% bill from 2020 in the same frame and show it in our next interview. He said he'll bring that frame when he comes to Korea for an interview in November. It's truly a frame worth celebrating, so I wanted to share it with all of you.
So in one of your memos, you said that because of the low inflation or low interest rate environment, the investors are walking on a moving walk and get a bit of a free ride on the moving walk. And with this sea change you're talking about, do you think we could be in the moment where the moving walk is actually coming backwards?
Not backwards, just stopping.
Stopping. Yes.
You see, in the memo, I give a list of the effects of low interest rates or declining interest rates. And among other things, number one, they make assets more valuable. If you own a company and it produces, 1 million won per year of profit, in a high interest rate environment, that's not such a good deal. But in a low interest rate environment, that's very desirable because it's hard to make that kind of money. So the value of that company rises. That's what happened in the 13 years. And companies, properties, shares, all rose in value. And the owners said, boy, I'm smart. But they didn't realize they were on a moving walkway. And by the way, if everybody's on the same moving walkway, then they all think that they're at equilibrium versus each other. The other thing is this. If you had a loan outstanding, the way I did, every year, your interest rate came down. So any transaction that you financed with borrowed money became smarter. So what about people who had bought assets using borrowed money? They had success two ways. Asset prices went up, cost of capital went down.
Right.
Well, what if that's over? You see, this is the main thing. If the moving walkway is not going to produce this free ride anymore, then we have to ask ourselves whether the strategies that worked in that period are going to be the strategies for the coming period. And I think the answer is clearly not so much.
Moving to a different topic from Silicon Valley Bank's bankruptcy to the crisis of regional banks. Could this perhaps be part of the sea change Howard talked about? Should we view this as a sign of another major crisis, or is it, as Jamie Dimon suggested, almost over, or as Jerome Powell described, Should we consider it just an inevitable event? I'd like to ask Howard what he thinks about this.
It's a good question. In the easy days that I describe, the 13 years, certain practices were encouraged. And in many cases, they were easy times practices. But when the times change and things become hard, maybe they don't work so well. So in easy times, when risk does not come home to hurt you, the person who takes the most risk makes the most money. And risk-taking is encouraged and continues and increases. As Warren Buffett says, when the tide goes out, we find out who was swimming without a bathing suit. And so when the conditions become normal or challenging, then the person who took the most risk has a problem. And that's much of what we saw. In thinking about our portfolios from the macro, I usually think about aggressiveness and defensiveness. This, to me, this is the main axis on which we have to decide.
Right.
So for you or for me or for Jay, there's a right amount of risk. There's a position on this line that's right for me. I don't have to save for my old age anymore. and I have plenty of money stored up. So I can afford to be aggressive. I can take a chance. Somebody else has to be more conservative because they have to ensure their future. So that's, we select our normal position. Then we say, what about today? Today, should I be more aggressive than usual or more defensive than usual? Well, the point is, nothing works all the time. Aggressive behavior makes you more money in the good times, but loses you money in the bad times. Conservative protects you in the bad times, but you have to look at others in the good times making more, which is challenging, produces envy. So the point is that the people who engaged in aggressive behavior in the good times had it perfect. But if they continue with that behavior when the times become more difficult, then they get into trouble. And there's an old saying in the lending business that the worst of loans are made in the best of times. So when things are going well and risk-taking is successful and there are no troublesome events, people become more and more aggressive and they relax their standards and they lend more money to weaker borrowers with less protection. And then when the cycle turns down, those are the ones that get into trouble. And so some of the banks that failed grew super fast, and some of them, like Silicon Valley Bank, were in an area concentrated. You know, these are regional banks. So the SVB concentrated on a region that was engaged in an aggressive activity of venture capital, which boomed in the good times, busted in the bad times. And that contributed, that was not the whole problem, but that contributed to its demise. So you're absolutely right. The change in the environment is very, very important, and it should not be overlooked.
Right.
As you may know, Jacob and Jay, when I was in college, I minored in Asian studies. And it brought me into contact with Asian philosophy. And I think one of the things I learned from that is the importance of attributing power to your environment. It's not how smart you are or how strong you are, but also your environment will determine a lot of what happens to you. And you don't necessarily have control over that or the ability to predict it. And you have to understand your environment and react appropriately. And I think that's what all of this is about.
That's truly moving. It seems the message was understand the environment well. Perhaps the mention of sea change means that if we understand significant environmental changes well, even without being extremely smart or strong, we can survive and perform well and build a great company like this. It seems that's the wisdom you're sharing with us.
I think that people tend to overestimate what's under their control. And our business, which means dealing with the unknown future, is much, much better if we understand our limitations and prepare for an unknown world rather than assume that we're in control and it will go as we expect.
And you kept saying that we don't necessarily know what's ahead of us, but more importantly is that we know that where we are now. So our next question is, it's related to your most classic investment book, The Most Important Thing. In that, you mentioned about the importance of second level thinking. And that is to say, in order to generate superior returns, you need to start thinking another level. So if you think about the broader equity market today, what are some of the things that second order thinkings or second order questions you are asking, and how does that translate to the second level of where the equity market is today?
It's really pretty easy, Jay. Everybody knows inflation is up. Everybody knows that the Fed has had to raise rates to fight the inflation. Everybody knows this will bring down the economy, slow it down. Probably have a recession, not too bad, we'll come out. I think everybody agrees on that. Some people think the Fed will pivot to dovish behavior, that is, reducing interest rates this year. Some people think next year. Not a very important distinction. But let's say that everybody agrees on the things I mentioned. That's not the important thing. The important thing is, then what? We all know what's going to happen over the next year. Information that everybody has is not helpful because we all have it. Investing is a matter of knowing something other people don't know. So this idea of what the next year holds is not very helpful. Nobody has taken issue with the basics of sea change, but nobody has said, oh yes, I agree, it's going to stay that way for 5 or 10 years. That's the important thing. If it's true that over the next 5 or 10 years, we're not going to have interest rates that are declining or ultra low, that's the important thing. And that means that the economy will not be as stimulated. Defaults and bankruptcy will be higher. Importantly, today, because interest rates are higher, an investor can get very good equity-type returns by investing in debt where your return is contractual. You're not depending on the market. You come from the fixed income world, so you lend out some money, the borrower promises you interest, and then he pays you back. And your return is a certainty as long as he pays you. If he doesn't pay you, you get his company. So he has a lot of incentive to pay you. Well, if you can get a high return on that basis, that's very attractive. And that means to me that to take the return, the risks that are associated with equities is not as important. And so I think that most investors, depending on their circumstances and their aspirations and their tax situation, most investors should have more debt in their portfolios today than they did 3, 6, 9 years ago. That's the biggest change for me. I wrote a memo called What Really Matters in November. And the main thing I was arguing against was this fixation on the short term. You know, how fast will inflation come down? How much will the Fed raise rates? Will that produce a recession? How bad a recession? How long will it last? These are not the important things. Your viewers running their portfolios should be concerned about 5, 10, 20 years, not 1 year. And so they have to think about things that are more long-lived than just the ups and downs of inflation, recession, and rates.
Regarding the sea change memo and what you just mentioned, I was reminded of something I had forgotten. Howard said when he first entered the industry, the most popular stocks were the Nifty 50 stocks. Back then, you were considered foolish not to buy these stocks, and people expected their prices would rise forever. Surprisingly, he mentioned that if you had held Nifty 50 stocks until 1974, you would have suffered a 90% investment loss. Even today, we see people getting excited about concentrated investments in certain sectors or assets while ignoring stocks with real value. Despite investment gurus like Howard continuing to advise, don't follow the crowd, always think contrarian, people don't change. So I'd like to ask Howard again, as an investment guru and senior mentor, to advise investors on how they should manage their mentality. I would appreciate if you could emphasize that point once again for us.
It's only natural that the stocks of better companies should be more expensive. Which are the better companies? That's the question, you know? In the Nifty 50, there were two beliefs, Jay. One was that these were companies that were so good that nothing bad could ever happen. And two, these are companies that were so good that for their stocks, there was no price too high. So people were not applying value discipline. They were worshiping at the altar of these companies. Now it happens, first of all, that at least half the companies ran into serious trouble. So this idea that nothing bad could ever happen was a big mistake. And I would say in many cases, among other things, there was a failure of second-level thinking. For example, one of the leading companies of the Nifty 50 was Xerox. And Xerox, at that time, had a monopoly position in dry copying without liquids. But not enough people said, hey, wait a minute. They have a monopoly. They're keeping the prices very high. That produces exceptional profits. But mightn't those profits attract competitors who would then require the prices to decline? They'll compete on price. How will Xerox do if it has to compete on price? And in fact, mostly Japanese copier companies developed competing products. I think Xerox either went bankrupt or got very close. Everybody knew Xerox was a great company. The question is, who asked, yeah, but is it sustainable? So that was number one. And then number two, this idea that there was no price too high for these stocks. I mean, I was lucky because I was a boy at the time, literally a boy. And I learned an important lesson in the 70s, which is that there are no assets which are so good that there's no price too high. For every asset, regardless of how good it is, there's such a thing as a bargain price, fair price, overprice. That's the realization that nobody had at the time. But some people said, yes, it's a great company, but it's not that great, you see. And this is the greatest example of second-level thinking. The first-level thinker says, it's a great company, you should buy the stock. It's simplistic, Everybody understands that? Probably wrong. The second level thinker says it's a great company, but it's not as great as everybody thinks. So as a result, it's overpriced. You should sell the stock. You see? You have to, that's a very simplistic example. But the point is you have to take your thinking to a higher level, more in-depth, more nuanced, asking more questions, not so superficial. And I'm very lucky to have learned this lesson at a very young age. By the way, you only learn from difficulty. Very few valuable lessons are learned through success.
Since you entered the industry in '69, it's been 54 years. I'd like to ask if you've been happy doing business and investing for 54 years, and what has been your driving force to consistently invest while sharing wisdom through memos for others?
When I was young and learning, people shared their wisdom with me. I can only do the same. I have to, we say, pay it forward. Pay it forward. Pay it forward. I'm just very happy to share my ideas. The ideas themselves are not the key to success. The key to success is good implementation. So I'm not worried that I'm going to give away my livelihood. But it just seems, if you read all the great mathematicians, philosophers, historians, aestheticians, everybody, they have an idea, they wrote it down, they shared it with the world. And I hope my ideas are worth sharing. I started off sending the memos to my clients. I thought they should have the benefit of my thinking. And of course it's bigger than that now. But still, I want to leave this world a better place. Now, I'm not able to be a statesman or a nuclear physicist or a polar explorer. I work in a small world. But, you know, I get a lot of letters from people who say, you changed my life. You helped me go in a new direction. To me, that is so gratifying that you know, that's what I did with my life. Hopefully, along with being a good husband, parent, grandfather, friend, community member. But the thought that you could make other people's lives better through your intellectual process is it's all you need.
In my opinion, Howard has done more meaningful work than any politician, nuclear physicist, or polar explorer for ordinary people, especially investors, I think so. Last week I went to Nebraska, Omaha, and saw Warren Buffett and Charlie Munger from afar at the Berkshire Hathaway shareholders meeting. As you know, Charlie Munger will turn 100 next year, and Warren Buffett is already in his 90s. Personally, I hope Howard will continue sharing wisdom with our investors even longer than them, and I wish you good health. So finally, I'd like to ask, how long do you plan to continue investing and sharing your insights through these memos?
I'll do it as long as I can. You know, it's extremely rewarding in my life, and it's so satisfying when you push through to an idea, to a thought you never had before. It's just the greatest thing, and this is what makes the profession of investing very interesting. And you know, I'd like to do it forever. I just spoke to Charlie yesterday, and you know, he's enjoying his life. Maybe I should have set a goal of 99. But my own father lived to 101, so maybe that should be my goal. But Warren Buffett, he talks about the fact that he skips to work in the morning, and I don't know if I can skip anymore. I don't know if he can skip, but the excitement of dealing with ideas keeps us excited about going to work. And when I lose that, I think I'll lose a lot. I look forward to interviewing with you both in 20 years.
Please,
We would love to.
please.
Very good.
Thank you very much. We're grateful for your humour and encouragement. And as mentioned, we sincerely hope you'll continue to work with us investors for a long time, and we look forward to another interview at our office in Seoul this November.
Thank you.
In Howard Marks' office at Oaktree, we've conducted an hour-long interview. It was truly a moving interview. I'd also like to thank Mr. Jae-Young Yang for co-interviewing.
Thank you very much.
Thank you.
Thank you very much.
Thank you to all our viewers who watched until now. Thank you.
Thank you.